Tom Boley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everybody, and welcome to this Tuesday, July 9th, 2024 edition of Trading Places Live at EarningsBeats.com. I'm Tom Boley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes or so as we try to figure out what's going on in the market today. Kind of an interesting setup this week. We do have a couple of big inflation reports coming up later in the week, Thursday and Friday. Thursday, we have the monthly CPI report. So June CPI will be out on Thursday. And then we've got the June PPI report coming out on Friday. Both of those are going to be really critical, obviously, because the Fed's going to be watching. I think more and more signs are being sent to the Fed to lower rates. We do have a Fed meeting later this month. I don't think they're going to do anything this month, although it wouldn't shock me to see some sort of a small rate cut. I believe, though, that we'll probably see that in September. I don't think the Fed's given the stock market adequate warning, or don't think the warning is the right word, but hasn't really, showed their hand that they're going to cut. They keep talking about the fact that they might even raise if they have to. So I think they probably are going to need this next meeting and maybe another month or two to try to at least be a little bit more transparent that a rate cut is coming. And I think that's going to be the chatter if these two reports, these two inflation reports later this week come in either at or below expectations. One thing to keep in mind from a more bearish perspective is that last year, the June 2023 core CPI report came in. It was at 0.19%. That was the lowest reading. That took a big drop in 2023. And so that's our comparison for 2024. The June 2024 number, we're going to lose that 0.19 number from a year ago, and we're going to replace it with whatever we come up with on Thursday morning. So if we come in at 0.2 or higher, the annual rate of core inflation is going to jump. And that is probably going to make folks just a little bit, maybe a little bit more nervous. It could kind of get that inflation talk going again. I don't know. We'll just have to wait and see how it comes out on Friday, Thursday and Friday. But Thursday is the CPI. Friday is the PPI. All right, let's take a look at the action from Monday. You can see the Dow Jones Industrial Average finishing down 31 points. Hopefully, by the way, the cursor is hopefully looking a little bit better on your screen. We've been working on that behind the scenes. So hopefully you'll be able to see things a little bit better. It's certainly very large on my screen, so hopefully you can see it on yours as well. Let us know in the comments. Anyhow, Dow down 31 points yesterday, S&P 500 gaining about 5 2/3, NASDAQ up 47, mid caps jumping about 10, and small caps up $1.41. That's on the IWM. And we saw transports, however, move lower again, closing yesterday at 15,158, which was back below both of the moving averages. So just when you think you get something going in transports, the carpet gets pulled, you're right back down below these moving averages. Going to want to watch to see what happens today. If you look across here at the AD lines on these 6 indices, you'll see these last 2 are the ones that are struggling, IWM and transports. And kind of where I am now with these, especially, I wrote a little bit about it to members on the IWM yesterday, just saying, maybe re-emphasizing that for me, I need to see this breakout. It's great to talk about what could happen down the road. And I started the year thinking this was going to be a really good year for small caps. We may still end up really well with small caps, but the way we're trading right now, I need to see it. It's kind of like, what is it? Is it Missouri, the show me state? Anyway, I need the show me chart. I need the IWM to break out. I need to see something. Same goes with transports. We can talk about transports, and I could show you the long-term chart, which I have shown. The long-term chart where transports and the S&P 500 tend to go up hand in hand over long periods of time. But every once in a while, you kind of have that period of maybe inverse correlation. And then the ship gets righted, and then the two kind of go together again. Well, we're not going together yet because transports yesterday down 0.8%. We saw the S&P go up and set a new all-time high. So we still got that inverse correlation in play. It's a show me chart. I need to see it on the transports. If we can get that breakout above 15.5, the recent high, and then especially above 15,750, I think that would really get things started. But until we see that, I think you have to remain cautious, the group. And I'm going to say the same thing. And when I say cautious, I mean more on a relative basis. I don't think transports are going down much. I don't think small caps are going to go down much. But if you've looked over the last 6, 7, 8 trading days, we've seen the S&P 500 taking off. We've seen the NASDAQ taking off. We've seen, even to maybe a lesser degree, the Dow moving back up. So we've seen a lot of that. But we're not seeing it with the mid caps, small caps, and the transports. We need to see more of that. Anyway, getting back to these AD lines, you can see these two are the weakest. So we're not really seeing the signs of accumulation like we are on the Dow, S&P, and NASDAQ, where we're seeing that AD line go up every single day, setting new highs. And even the mid caps, I would kind of say the mid caps are like a bridge down to the IWM and the transports. So the mid caps are showing pretty good AD line, just actually moved to a new high within the last week or so, even though the downtrend remains. So mid caps are showing a little bit more strength relative to the small caps and the transports. Anyhow, moving on to the sectors, you can see technology up a little bit, up $1.59. That's up roughly 0.2% yesterday. Materials, real estate, the next two in line, dropping off a bit though in terms of their gains. Materials gaining 0.3%, real estate almost 0.25%. And then getting into the areas where we've seen some strength in terms of industry groups, or where we saw strength yesterday, furnishings, which have been horrible, continuing to move lower and lower in this downtrend, got a nice pop yesterday, jumping 3.7%. This is one of the groups in the consumer discretionary area that had not been doing very well. We've got a few of those. Interesting part, though, is look at the AD line. As the index keeps going lower and lower, we're actually seeing, we saw the AD line move to a new high. Now, part of that was a big jump. You can see the huge volume here. I don't know if that was option expiration. Sometimes the AD line can be a little misleading, because if you have a lot of volume because of, say, option expiration, in this case, it was quad witching, which we know is a big day. I don't know if that was what it had to do with, but anyway, it was big volume. You don't even have to do anything. You just have to finish at the high of the day. You could have a pretty flat day that really you don't do much of anything, but if you close at the high of the day or close to the high of the day, all of this volume gets added. So every once in a while, you see some weird things transpire on the AD line, and that's kind of what it looks like here to me, because since that day, we've been going mostly flat, and prior to that day, we were still downtrending. So this looks a little bit better, I think, because of just this anomaly here with this large volume, along with something that happened that day. It looks like, I don't know. Let's pull this chart up and take a look and see. Yeah, it was the day. It actually was option expiration day. I don't know if that had something to do with it, but you can see the volume was heavier than anything we have seen over the course of the past year. And we finished right on the high that day. So anyway, furnishings certainly looking better, but at the same time, understand the limitation of the AD line. You have to understand the calculation. Renewable energy, which had been weak. First of all, it was strong, started strengthening April, May into June. And then the last 3 or 4 weeks or so, we've seen this big decline. Well, the group started to bounce again yesterday, jumping 2.25%, which was about 9 1/3 points, and trying to get back up above its moving averages. So we'll kind of watch that. Renewable energy does have a history of making big moves in both directions and doing it quickly. So if you're someone who likes to trade these really fast moving areas to try and get some quick gains, renewable energy is for you. The only bad thing is it can go against you. So if you think it's going up, sometimes these things can fall apart. This group can fall apart pretty quickly, as we've seen over the last 3 or 4 weeks. And that followed a period where we went straight up very quickly for maybe a week, week and a half. So just understand the the additional risks in that group because you have such volatility and such fast moving stocks. And then we get the semiconductors. Semiconductors, welcome back. We've got a nice little move back to the upside, although they did finish well off their highs. They did still finish up. The Dow Jones US Semiconductor Index, anyway, did finish up 2% on the day. So it was nice to see the rebound, but this still looks a little bit like what we saw back in March, where we dipped, kind of moved back up, didn't quite get back to the highs, and then back down again. I just would be careful with the group. I think right now the risk is high in semiconductors. So you can trade it. I'm not saying you can't trade it. I'm not saying NVIDIA is not going to go back to another new high. Maybe we're going to go right back up. All I've said is we have made a huge move in semiconductors. Again, 900 is where that index was back at the end of October. 900. At this high in June, we were at 2100. That is 133% gain in 8 months, 7.5 months. That's a lot for any group, including semiconductors. That was the largest 7.5. Actually, I think I put on a chart. I can't remember. I think I did an 8-month rate of change. And this 8-month rate of change on the semiconductors was the largest ever over an 8-month period. So at least be aware that, hey, we may have gotten a little ahead of ourselves. That's why I'm nervous about the group. It has nothing to do with the quality of companies that make up the Dow Jones US Semiconductor Index. I mean, NVIDIA, love the stock. AMD, I love the stock. AMD actually starting to bounce back a little stronger than some of the others. So maybe keep an eye on that one. But Applied Materials, Qualcomm is, strengthened and starting to rise back up again. There's a lot of reason to like these stocks. It's just that if they don't go up in the near term, then it's money being wasted that could be on some other areas that are gaining ground. We've seen Amazon and the broadline retailers, Tesla and the autos, Google, Meta, Netflix, all in the internet space. And then we got tons of software companies, Microsoft setting highs every day. We got leaders like CrowdStrike that are in bull flags right now, just waiting for the next breakout. So we've got other areas that I think, may outperform the semiconductors over the course of the next few weeks, maybe next few months. So it's just a matter of gauging your risk and how much risk you're willing to take. Because I just think you have to take on a lot more risk right now in the semiconductors than what we had been when we were trending higher. Once you print that bearish engulfing candle, I mean, you look at just about any semiconductor chart, whether it's the indexes, whether it's the SMH. I mean, you see this bearish engulfing right there, and you see the one that we had in March. You get a long uptrend, extended uptrend, and then you have this big bearish engulfing candle. To me, it's just a visual. It's like somebody beating me over the head with a hammer that, hey, we are overbought and this group needs a rest. And so when you get that, you get increasing volume to go along with it. It suggests that market makers may be in on this move and that some institutions may be lightening the load a little bit. And as a result, you can see we did suffer here for about 6 weeks in the semiconductor space. I don't know how this is going to play out. All I know is that the risks are higher. If you want to take the risks, go for it. But I'm just saying, to get back up through 21,000, it's not the same as where you're going sideways here and you're looking to break out. Or even on a shallow pullback, where you come back up and break out. This, again, is after an extended run with a massive reversing candle and on heavy, heavy volume. Now, some of this may have been options related. For sure, there were a ton of in-the-money calls. So maybe it's just options related. Market makers finally said, hey, enough's enough. And maybe we are going to go right back up. I don't know. Watch the 21,000 level. If we fail, if we go up there and you see an intraday move above 21,000 with a close back down, say at the low of the day, and a failed breakout, that would be maybe signal number 2 that, we probably, most likely, not guaranteed, but most likely on a failed breakout, we would head lower. So anyway, spending a little bit of time on this group, but this is one of the more interesting and potentially volatile groups that we have right now. And regardless of whether you're trading on the long side or the short side, I think you need to respect these tops until they're taken out. All right, let's move on to the 10-year Treasury yield and get the update. See where we are right now. We're at 429, so we've moved up a little bit, but you can see the last 4 days from all of last week, we went down. Or actually, I guess that was Monday, the 1st, we went up, had a nice gap up. Tried to get through that 450 area, failed. And then Tuesday, Wednesday, Friday, and yesterday, last 4 days, all down in the yield, back down into the close to the mid 420s. Today, we at least jumped up again, kind of like we did yesterday, jumped up at the open. Where do we go from here? I don't know. But while we've been coming down in these yields, you can see financials have been struggling on a relative basis, and so have the industrials. So when rates were going up, we saw both of these groups doing well. As rates come down, these groups are struggling. Let's move over to the S&P 500. So we kind of opened and closed at the same level yesterday. Opened at 55.72.75, closed at 55.72.85. So literally almost an exact close of the open. So that's a doji. And let's see. How about we do it this way? Just going to pull up a 3-month chart just so we can zero in a little bit. Here are the 3 white soldiers. Those are bullish. That's a bullish setup. Doesn't mean you can't pull back short term, but I'm just saying there's a pretty good chance we keep going higher based on that move. Those 3 white soldiers and 3 breakouts to all-time highs. Even yesterday was another close at an all-time high. We saw it on both the S&P 500 and then also again on the NASDAQ 100 and on the NASDAQ. So we're seeing more moves to the upside. We're seeing more new highs being set, but that is a kind of a hesitation kind of a candle. And, we'll see where we go from here. I will give you the futures this morning, which I hadn't given you. I apologize for that. The diamonds, and we've got about 13 minutes to go to the opening bell. The diamonds are flat, down 2 cents. S&P 500, the SPY, up 0.2%. Now jumping up more than $1 on the SPY to 556.33. So it looks like yet another open. And what we saw yesterday, these opens and maybe even these smaller candles. I mean, I know we finished, with hollow candles, so we finished above the open. But I've said with a VIX down in the 12s, this is the kind of action you see. If you're sitting there as a bear, you might be sitting there waiting. Hey, it's way overbought. Semiconductors are going to lead us down. And yet the market keeps going up. Even when the semiconductors were going down, we didn't really see any major selling in the S&P 500 because of rotation. Rotation is so important in secular bull market advances. It's probably the most overlooked thing because you don't have the same leaders throughout a secular bull market. Even within one advance, you can see the leaders rotate. And that's exactly what we're seeing. So VIX at 12, I've been talking about this for months and months and months and months and months. When the VIX is down below 13, we tend to do our absolute most bullish work in our major indices. And same thing's happening now. Anyway, let's take a look at the QQQ. Pre-market up $1.54. It's getting close to 500, 498.88. That's up 0.3%. So clearly still strength, relative strength in that area. And then small caps were down earlier. Let me see. Yeah, down 0.14%. So we're still seeing small caps trailing. And this past week was a really brutal week. I'm talking about last week from the 1st through the 5th was a brutal week in terms of the intraday rotation away from the small caps. And that was one of the things that I've been talking about, saying, hey, small caps kind of being accumulated under the surface during the trading day. That went right out the window last week. We had intraday breakdowns on the IWM relative to the QQQ. So there's, at this point, I still think long-term IWM's in an uptrend, and we'll take a look at that chart in just a minute. But right now, in the short term, we have to see a breakout. We got to see a breakout before getting too excited about the group. Because again, look at what we're seeing in terms of the QQQ moving higher. And then if we pull up the IWM over the same period, we were moving higher back in mid-May, but these last 6-7 weeks have been really brutal on a relative basis for the small caps. And, clearly we got to get through that 210, 211 area. We got up to 209 in mid-May, couldn't get through. And now we pulled back. AD line is hanging in. It's okay. Again, I don't think this group is bearish. It's just we're in a bull market. We keep going up every day in the major indices except this one and transports and mid caps. Those are the ones that continue to lag. We need a breakout, and so far haven't gotten it. The transports, again, rolling over. There was another false breakout. That would have been back on Thursday or Wednesday of last week. Friday, after a false breakout, we roll over. And then yesterday, we just continued the move. Came off of the bottom a little bit, finishing off the lows of the day, but still closing below the 20 and the 50-day moving average, which we had not done for about the last 10, 11 trading days. We went up above it back in mid-June, and we had stayed above that rising 20-day moving average until yesterday. So, and AD line hasn't broken to a new low, but neither has price. So, if we were to go all the way back down and clear 14.8 to the downside, that would be another bad signal for transports. And those who follow the Dow theory know that, the Dow recently went up to 40,000, closed at a new all-time high. Transports have not confirmed that. So that is your Dow theory, that it's very bullish when one goes to a new high and the other comes up and goes and does the same to confirm that move. Not seeing that so far. So the Dow theory is bearish right now. So if you're looking for things to hang your hat on, this certainly would be one of them. Now, personally, for me, do I think that the Dow transports following the Dow Jones is the most important signal in the stock market? I don't. It's a signal, but I think it's a secondary indicator, just like all the other secondary indicators out there. For me, it's all about price volume. And when I look at the major indices, I'm looking at the S&P 500 and I'm looking at the NASDAQ, I'm seeing nothing but higher highs, higher lows, volume trend strong. My sustainability ratios are suggesting that it's going to continue. The VIX down at 12 says that's, the VIX at 12 is not where bear markets are born. They're not. We don't start to see big breakdowns in our major indices until the VIX is well up into the upper teens or even close to 20, maybe in the 20s. When you see the VIX at that level and you're getting a price breakdown, find shelter. That's all I got to say. That's what I do. If you look back at the worst times to be in the stock market, it's when price action is trending lower and you've got the VIX over 20. I can almost guarantee you that every time the market is showing some extended weakness, like really starting to roll over, go back to all the recent secular bear markets that we've had, or even the cyclical bear markets that we've had over the past few years. During every one of those, we get price breakdowns and we get the VIX above 20. Right now, we're sitting at all-time highs with the VIX at 12 and change. Not the time to be bearish, in my opinion. Anyway, let's move on. So heading over to my home at EarningsBeats.com, you can see a couple of things. First, you can sign up for a no-cost trial, 30-day free trial. We'd love to have you in, check out our service. There's a reason why folks have stuck with us. Our guidance, in my opinion, our guidance has been second to none. I don't know anyone out there that has called the stock market better than we have since back before the pandemic. We've hit almost every major top and major bottom in the market. The only one that I would say we didn't hit was the pandemic. And we had a couple of signs back then even that were suggesting we might have, roll over, but kind of hard to predict 100-year pandemics. They don't come along very often. There's no real textbook or playbook to go by. But I think other than that, and even in the middle of that, I said, hey, we're in a secular bull market. This isn't going to last. It's a healthcare crisis, not a financial crisis. And I was proven correct in that literally just a month later, 2 months later, or whatever. The S&P and NASDAQ were back at all-time highs. Anyway, I think, or maybe it was June of that year. I don't remember exactly when we made the breakout, but my point is our guidance has been really good. We do a weekly market report that gives you a little bit more of the big picture, because I do a lot of the shows and I do our daily market report. And a lot of that focuses on the near term. What are we doing right now? And the weekly report, which has been a great addition, is more of the bigger picture. So if you're somebody who's looking to manage 401ks, that sort of thing, I think our weekly market report is something that you probably really should be following. Anyhow, 30 days, you get everything we offer for free. So make sure you check that out. Also, I think one of the most popular things we have talked about since we've been in business has been the history of the S&P 500. If you don't understand how history works, please go to our website, click on this free, download this free report and check it out. I mean, if you don't know that, there's so many different things that go on in the stock market, but one in particular, more than 80% of the S&P 500 gains since 1950, we're going back 75 years, more than 80% of the gains have been in a 11 consecutive day period of the calendar month. So roughly 1/3 of the calendar month, maybe a little bit more than 1/3 of the calendar month, has produced 80% of the gains. Now, I don't care if if you're in for the long haul, maybe you don't even care about that. If you're just letting everything go. But, if you get swayed by temporary moves to the downside, you need to understand how history works and keep perspective of things. But these 11 days, if you're an options trader, this is gold. If you know the 11 consecutive days of the month when we make up more than 80% of the gains over the last 75 years, would that not help you in options trading? I just pointed out, we're giving it away for free, folks. Check it out. Anyhow, if you want, you can always subscribe directly into our EB Digest as well. This is a 2 times a week report our newsletter that we offer. No credit card required. Same thing with that PDF, by the way, on the Bowley trend, which talks about the historical trends in the S&P 500. No credit card. Just enjoy, learn. We're giving back. A lot of the research we've done, we're actually giving back. And this EB Digest is another way we give back. Name and email address, all it takes. No credit card. You can unsubscribe at any time. But why not get a couple of free newsletters? I talk about individual stocks. I'll talk about things that are really important to us, like relative strength, candlesticks, gaps, how you trade gaps, how I trade gaps. There's a lot of really good information in here that just gives you a lot of detail about how we at EarningsBeats look at the market, view the market, and how we trade the market. So anyhow, make sure you check that out. And if you look at this history of success here that we've had, our flagship model portfolio, which, look at the inception date on this. We started this back in middle of November of 2018. So that was during the trade war. Remember, that was the fourth quarter of 2018. We unleashed this model portfolio during a 20% cyclical bear market, right in the middle of it, right when it was going straight down. We've only been long, by the way. There have been no short positions, and we've not been in cash. We actually are in stocks ever since then. Think about it. We've been in through the cyclical bear market of 2018, the trade war. We've been in it through the pandemic, where we lost 35% in 4 weeks on the S&P 500. That was in March 2020 or 2020. 2022, the cyclical bear market. Remember that? We were invested long. Now, we did take some precautions, and we were in a little bit more defensive areas because we saw that cyclical bear market coming. Said it at the beginning of the year. We thought we could have a 20 to 25% drop in the first 6 months of the year. And I beg you to go back and take a look at that. It's exactly what we saw. So had to battle through that. And then, all of the different rotation and everything that we've seen over the past few years, our model portfolio, which is our flagship, has gained 225%. So 100% is a double. 200% is a triple since that date. The S&P 500 has now just more than doubled. We have easily more than tripled. And so you can see the performance is quite a bit different. And through last Friday, and I think it even got better yesterday, but through last Friday, you can see this quarter, we're up again another 3.4 percentage points above the S&P 500. This is part of our service. We have a lot going on at EarningsBeats. Anyway, I just wanted to point out a lot of information that you could be getting, and to do it for free for the next 30 days while we see what this market is going to do in the summertime, heading into the more bearish months of August and September, probably not a bad time to think about checking us out. Anyhow, the chart of the day, the one I wanted to look at today was Intel. So you can see over here on the far right part of the chart, we've been downtrending. And this has been during a period when semiconductors, for the most part, been screaming higher. So I don't even have to tell you, but I'll show you on a relative strength chart how bad this stock has been. Here's Intel relative to the semiconductors since December of last year. So basically, this is a 2024 thing. Intel has been getting clobbered by its peers within the semiconductor space. I think that's pretty obvious. I mean, here, semiconductors have been going straight up, and Intel has been going straight down relative to the group. Well, look at what has happened here recently. So things have been picking up, and now all of a sudden we're seeing these big moves, and we're starting to see the AD line move up. So is this the time to jump into Intel? Probably be a little more cautious. I mean, listen, if Intel straightens itself out, I mean, we got a lot more room to the upside. There's no doubt about it. So jumping in with the first sign of strength might be a little premature. And I wanted to show you the weekly chart and why I'm saying that. Here is the weekly chart. Now, we just started this week. I mean, there's the big move up so far this week. We don't know where we're going to finish, but we could actually have a failure of that 20-week moving average and go right back down to the lows. The thing that I don't like about this chart right now is that, we're moving down, and when we come back up here at the low, the weekly PPO is still negative. I mean, still pointing lower. It's still going down, meaning that we've got bearish momentum. Anytime the PPO line is below that center line, below zero, you've got bearish momentum. Now, as you start to turn up, it's not bullish momentum. It's telling you that now you have less bearish momentum until you get through the center line. When you get above the center line, then you have bullish momentum. You don't have bullish momentum until you get through that center line. Not according to the default readings, the 12 and 26 period EMAs. So keep that in mind. So right now we're having an intraday breakout, an intra-week breakout. We don't know where this is going to finish. So I think it's still a little premature to jump into Intel. Now let's take a look, and that would be, this is as of 9:32. So this does include this morning as well. So we'll pull up a 10-minute 5-day chart, and you can see yesterday we were at 34. Today we're now above 35. So if we go back to that weekly chart, we were actually below this 20-week moving average at the close yesterday. So it was today's action. We don't know even if we're going to close above it by the end of the day. We'll see. But Intel, anyway, getting a pretty good move there. I'll show you the overall indices here in just 1 minute. But let me, I'm going to look at this. Let's see what the QQQ is doing. So another high. Now we're up over 499, getting close to that 500 level. Spider, same thing. So not only did we have futures up, we're now moving higher. That's what this first hollow candle is telling me. This is an intraday chart. So this is the first 10-minute chart. We're only, 4 or 5 minutes in. So this is just giving us the first 10 minutes right now of the action today. So far, pretty good. IWM, is it doing? Nope. Big sell-off. It's going in the other direction. Can't exactly explain why, but it is. And so that is, well, I know one of the reasons why many of the components of the IWM are not posting profits. But we've known that. I mean, that's generally the case with the IWM. Rarely are you going to see, 90% of the IWM components making money. Anyway, IWT there. We also can pull up the trends index, and there you can see breaking back down to new lows. So rolling over and not trading well. And yet you get into some of the stocks like Apple, which gapped up, has actually come back down a little bit. How about Microsoft? Same kind of a deal. Let's see NVIDIA, some of the semis. There you go. So NVIDIA, which had pulled back yesterday, kind of left that early morning strength, long tail to the top on a daily chart candle, right back up to the new high. Now, it's got to get back up to 140, 141 to clear resistance, and we're only at 131, but at least the semiconductors back in favor here in the near term. We'll see whether or not they can continue that push to the upside, but it certainly looks like, at least based on NVIDIA, that it's the semiconductors once again that are helping to push the major indices to a new high. Some of the others, of course, Tesla's been on fire. It opened down, but it's back up again a little bit. Google, nice move there. Amazon, trending up again. Meta, which recently had a big day, jumped up, trying to strengthen there. A couple of others. How about Netflix? Gap up, but not too much off of that so far. Costco, big move up. CMG, these are all stocks that I watch pretty closely. CMG's been getting hit pretty hard. Now coming up today, I don't know if maybe we're going to see some kind of reversing candle, but that would be useful on the daily chart after the big red candle there. We're back into this gap support zone. Right around $60 is where we made the breakout back in April from earnings. We're back down testing that 60 area. Reversing candle here is something that I would at least have on my radar watching to see. And some of these stocks also, what I do is I like to pull up the relative strength, my relative strength, so I can look at the AD line. AD line on CMG has not been really, since the gap up all the way back in March, really. The AD line topped and it's just been going sideways. So even though we kept going up, this is one of those stocks that really hasn't shown great strength. I mean, if we pull up something like Meta, as we've been going up, look at the move up in the AD, even on the gap down. See, the gap down, the AD line jumped. If you looked at the OBV on balance volume, it went down because OBV only cares about where we close, doesn't care about how we traded during the day. So anyway, Meta has been on fire. We've seen very, very few red-filled candles. Most of them have been hollow, and it's supported by this AD line going higher. So I'm seeing accumulation. I think any weakness, if Meta were to get back, say, to 510, 520, I'd be all over it. I mean, I'll tell you, personally, I own some Meta. So full disclosure. But any kind of a pullback would make it even more attractive. I would add to it if it were down to the 510, 520, somewhere in that range. We just had a big breakout after going sideways for a while. Made a big breakout, taking out all of these various highs. AD line strong, part of the QQQ, which is certainly in favor. It's part of the internet, which recently made a breakout on a relative basis. Here's internet versus the S&P 500. See how we sideways consolidated? And then when semiconductors started to struggle on a relative basis and moved lower, money rotated into the internet group. Internet's broke out. So you got one of the best stocks long-term versus, in one of the strongest areas right now in terms of relative strength. So anyway, that's kind of how I focus on the market. Let's get a look, though, back at the dashboard, back to our home page. See, we got the Dow down slightly, small caps, mid caps, both down, NASDAQ and S&P going up. So it's the same bifurcated market that, quite honestly, we've seen probably almost since 2021. That was the last time we had a big run in the small caps and the mid caps. And even the Dow, had a bigger run, earlier, and is kind of, trailed off a bit in terms of relative strength to the S&P and the NASDAQ. So for now, this is where that strength continues. NASDAQ, S&P 500, and who am I to argue with it? We been doing it, continuing to do it. Rates are going to drop, in my opinion. Some of you might think otherwise. I think it's a slam dunk. I think the only question is when. I think we're already seeing signs that, to me, suggest the Fed should start cutting now. But we'll see what happens later this month. Anyhow, that is it for me today. I appreciate everybody tuning in. And I'll be back next Tuesday for your next Trading Places Live here. But remember, I am doing a new show over at Stock Charts on Thursdays. Normally, it will be out around 1 o'clock, probably in the afternoon. So you could tune in, look for it on YouTube or subscribe to the Stock Charts channel so you'll know exactly. You'll be notified if you turn your notifications on. You'll be notified when that hits. Yeah, Thursday show is a little bit different kind of a show. I'm really enjoying it. So hopefully you're tuning into that as well. And then also on Wednesdays, don't forget, if you sign up for our 30-day free trial to join our service, we have live trading Wednesday at 10 a.m. So you'll get the next 5 of those live trading sessions. So check it all out. I mean, we offer a lot, especially for a 30-day period when you don't have to pay anything. Anyway, have a great day, everybody. Happy trading.